Good morning and welcome to today's webcast, Qualified Opportunity Zones, Trends for Your Company. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And I'm pleased to introduce today's presenters from Moss Adams. Chris Paris, partner in NorCal Regional Industry Group Reader for Real Estate, and Chris Herthel, director with Moss Adams Advisory Services. And Chris, I'll turn the line over to you to get us started.
Thank you, Emily, and good morning, everyone. So as you saw, you have the dual Chris's presenting today. I'm Chris Herthel. I'll be covering the first section and the third section. My background is in real estate advisory and business consulting, and then my colleague Chris Paris will be handling sections 2 and 4, and he's the accountant in the group, so we'll be getting into some more of the technical issues. So today we'll discuss some current trends in qualified opportunity zones. We'll talk about some formation structuring. We'll get into some potential pitfalls of opportunity zones. And then lastly, we'll close out with a comparison between opportunity zone and 1031 like-kind exchanges. And I will say, too, that because most of the action has occurred in the real estate space as it relates to opportunity zones, relative to the operating business elements of the legislation, this presentation will largely focus on real estate aspects, but we will have some opportunity zone information for operating businesses. So, Emily, our first poll question.
All right, our first polling question. How would you characterize your knowledge of qualified opportunity zones? And your options are, I have no knowledge, basic knowledge, enough to be dangerous, or expert. And I'll give everyone a few moments to respond. To participate in our polling questions today, please click the button next to the answer you choose and hit submit. And if you're having any trouble seeing the polls, you can refresh your browser with F5. I'll give everybody a couple more seconds. And let's go ahead and take a look at the results. Chris, back to you.
Great, thank you. So it looks like the majority of the group has basic knowledge, and then Some have no knowledge and some have enough to be dangerous, so that's great. Very few of us are experts. I think that goes for all of us, given that the regulations around opportunity zones are still evolving. So thank you very much for your response. So let's jump into the presentation here. First slide, some current trends. So just to sort of put some brackets around the size of this potential market of opportunity zone, according to the government numbers, there's about $6.1 trillion in unrealized capital gains as of year-end 2017. And as you may know, the opportunity zone legislation is really geared towards spurring investment in lower income areas in need by directing capital gains to those areas and the tax advantages that result. So according to the government, there's $6.1 trillion in unrealized capital gains. Theoretically, some of that could go into opportunity zones. Our Treasury Secretary has predicted that about $100 billion will, in fact, end up in opportunity zones, whether through real estate investments or operating business investments. So if we look at some of the activity that's transpired since the legislation came out a couple years ago, there's about 96 identified funds that have been organized to invest in opportunity zones. And I would say this is definitely understated because these are really the funds that have been identified and so are marketing to outside investors. But we know that there are plenty more that are being marketed on a private basis with small groups. So we think there's probably upwards of 200 funds that have been set up to execute on this opportunity zone legislation incentive. And if you take those 96 funds that have been identified, they've targeted about $25 billion of capital to be raised around this strategy. So there certainly has been lots of hype around this new legislation, and we're starting to see a fair amount of fundraising. However, with that said, we haven't seen a whole lot of completed transactions yet. And, I think a lot of people are still trying to figure out what the regulations are, how to take advantage of them, and whether or not this is the right fit. Some of the early movers in the space were already active in these opportunity zones, and they may have already had real estate transactions that they had identified prior to the legislation, and they just happen to be in the right place at the right time and can now benefit from this tax incentive. Some early indications on transactions that have occurred in opportunity zones have been around universities, hospitals, government centers, and also affordable housing projects. We're seeing a fair amount of early activity in the affordable housing space as a good use in an opportunity zone. An example of this has been Avanath Capital, low-income housing provider here in Orange County, California. They've raised a fund of $200 million to target projects of low-income housing in opportunity zones. Some of the first movers have been largely big funds that have the resources and the capital to get the tax accountants and the lawyers on board quickly to figure out these regulations and the best way to take advantage of them. And we've also seen some integrated operators, so groups that have a vertical integration of construction, real estate investment, and government contacts within these opportunity zones that are starting to take advantage on the front end here. We're also seeing, because of the startup costs and to get going in an opportunity zone can be substantial, we are seeing incubators pop up that are being funded through some family foundations and other philanthropic organizations that are helping groups set up these funds so they can start to execute on their socially conscious goals, but may not have the adequate resources to get the teams in place to take advantage of this legislation. We're also starting to see different forms of taking shape where people are forming these funds in different ways. I think one of the things that we've seen taking the lead is the REIT model, real estate investment trust model, where a lot of real estate investors are forming their funds under a REIT model, and that's largely due to the flexibility that it offers. And my colleague Chris Paris will get into that in a little while. We're also starting to see a growing awareness of doubling up on incentives. It's important to understand that historically a lot of the government incentives when it came to investing in low-income areas or areas in need, they were largely debt instruments or tax credit instruments. And it's important to note that this opportunity zone legislation really is an equity instrument. So it's possible, and in many cases very beneficial, to double up and utilize the opportunity zone incentives along with other incentives that are out there, whether it be low-income housing tax credits, new market tax credits, or if you're talking about housing, HUD financing. So it's nice to be able to combine these incentives together, and there's no limit to be able to do that. So there's a fair amount of people that are taking advantage of that. There's a example of a 120-unit multifamily project in Orlando that successfully utilized the opportunity zone benefits alongside low-income housing tax credits. The other interesting thing is many states are starting to roll out their own incentive program to match up with this federal program. An example there is the state of Ohio just put forward a new budget that allowed a 10% tax credit to investors in opportunity zones. So it'd be very interesting to be able to double up on incentives, whether they're in the tax credit world or some of the local and state incentives. Another trend that we're seeing is fortunately, this legislation of opportunity zones has bipartisan support. So the ongoing evolving regulations that have come out have continued to be favorable and continue to have bipartisan support. With that said, we are starting to see some backlash from community groups and others that this legislation is going to only positively impact a small amount of these opportunity zones throughout the country, and that there's more press coming out about how this may be, quote, a gentrification subsidy, helping people, areas that were already gentrifying even further while sort of missing out on some of the other areas. There's been some articles that have come out that have been negative towards this program. So, whether or not this backlash starts getting back to the politicians that are crafting and the legislation and the ongoing regulations, we'll have to see. I did have a colleague that was attending the IRS hearing on this several weeks ago, and there was a majority of the commentary was negative towards this program. So we'll have to keep an eye on that as this thing evolves, and maybe some of these ongoing reporting requirements that are part of the legislation may become more onerous as a result of some of this backlash. The next trend that we're seeing is, obviously with all the hype, there's a lot of groups that are entering the market trying to take advantage of this, seeking investors to join them. And so, we are seeing some groups that may not be totally qualified jumping into the fray here. And so whether it's groups that just haven't been active in these types of markets before, or with product types in terms of real estate that they've been involved in before. So we are seeing some folks get in that probably aren't qualified. So we would just sort of make that warning out there to any of you that are looking to invest in a fund or potentially invest in a business within an opportunity zone. It's buyer beware. So. And the next one is, I think people are starting to figure out that while this program is very valuable and can work very well for a lot of folks, it does have limitations. And so we need to think through those thoughtfully. We will hit on some of these in more detail in a little while. And then the last trend that we're seeing is given the amount of money that's talked about and actively being raised for investing within opportunity zones, whether it's $25 billion that's been identified or the $100 billion that the secretary talked about, people are starting to wonder whether or not there's enough deal flow to satisfy all the capital that's being raised. And we'll also hit on some metrics on that in a little while. So with that, I'll hand it over to my colleague, Chris Paris.
Yeah.
Actually, we'll have another polling question first.
Yep. No, thanks. Thanks everyone who's joining the webinar this morning. Appreciate it. And Chris, you did a great overview to kick us off. So thank you. And Emily, I'm going to turn over the polling question to you.
All right. Our second polling question: in contemplating the formation of your QOF investment fund strategy, what do you anticipate focusing on? And your options are REIT structure, single asset QOF, multi-property QOF fund, or I'm just here to learn more. I'll give everyone a few seconds. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. A couple more seconds. And let's see what everybody has to say. Chris, back to you.
All right. Great. Well, so it looks like we've got a lot of people that are here to learn more, and then a lot of people doing single asset deals. And I would just say, overall, that's pretty consistent with what we're seeing so far. I think Chris Herthel, when he mentioned who's getting involved in this, a lot of the activity that we're currently seeing is sponsor activity for folks who are already active in these markets, and they either had a piece of property tied up or they already owned a piece of land that happened to end up falling into one of these designated census tracts. So they were likely going to do the project anyway. And then having the opportunity zone benefits just kind of makes the project even more appealing from a fundraising perspective. And even if the sponsor's looking at actually keeping the property for themselves. So it just kind of added attraction to a project that they were likely already going to do. We have seen some dedicated fund structures coming through. They're being established. They're ready to go. They're ready to deploy capital. The challenge has been just a kind of meeting all the qualified opportunity fund requirements when you have that type of a structure, because you've got the timing issues on taking in investor capital gain equity. You've got the timing issues on deploying the capital into the projects and going vertical on the construction of the projects. So we have definitely seen more activity, kind of single asset type transaction as opposed to a dedicated fund structure. And I think that's consistent with what we just saw in the poll results. On the formation side, a couple things we wanted to cover today are just direct versus indirect asset ownership. And what that means is the investors could potentially invest directly into an asset-owning entity who would operate the real estate project. Alternatively, the investors could come into a holding company, which would be the qualified opportunity fund, who would in turn invest into the asset-owning entity. And there's some differences there, and there's some advantages and disadvantages to doing it either way, so we're going to cover that a little bit. Capitalizing on pre-existing owned property. As we mentioned, a lot of folks already own property in the zone, and the difficult thing is how the program works is you can't just own property in the zone and obtain all of the favorable tax benefits on it. What the government's trying to do is really spur economic activity in these census tracts. So in order to take advantage of some of the tax savings that are available here, you really have to put some substantial amount of money into the property, substantially improve it, rehab it, or ground up new development to get a lot of the tax benefits. So capitalizing on pre-existing owned property is an area where we're seeing a lot of activity, and there are ways of structuring that. And so you just have to be mindful of how you're doing that. Debt guarantees, depreciation expense, and loss limitations. These are more applicable when you've got a sponsor that's doing a qualified opportunity fund and actually raising equity for the deal. So there's some things you need to be aware of there. And then on the equity partner side, a lot of the deals that we're seeing put together, particularly these single asset deals, it's really a combination of investors who are investing capital gains and they're going to obtain the qualified opportunity fund tax advantages, but then there's also some partners that are putting in new equity, so we refer to that as fresh capital. What that means is it's not capital gain income that's being invested, but it's fresh capital being put in either by the same investor that's putting in capital gain income or a different investor altogether. So on the direct versus indirect ownership topic, the fund can own the asset directly. That's qualified opportunity zone business property. And I know we're throwing a lot of acronyms at you here, but the QOZBP is qualified opportunity zone business property. That's when the fund owns the real estate project itself or the operating business itself. Alternatively, you can work through a holding company structure where the qualified opportunity fund is an investor in another legal entity, which is the asset owning entity. And so then your fund basically sits above the asset owning entity, and you've got different qualification tests here. So I would say just generally, thus far, what we're seeing is the fund sit above the asset owning entity. And there's a few different reasons for that. One, in order to qualify as a qualified opportunity fund, you basically have to invest the money into these targeted census tract areas. If you do it directly, it's a 90-10 test, meaning 90% of your assets have to be invested in qualified opportunity zone business property. If you do it through a tiered entity structure, it's a 70-30 test, which means that only 70% of your assets have to be invested into the qualified opportunity zone census tract areas. And so if you were contemplating like a multi-asset structure where you were actually going to have some assets that were located outside of the zone, you could theoretically accomplish that through this 70-30 test. Also gives you more flexibility in terms of sitting on excess cash and idle investments and what have you while you're waiting to deploy the capital in the project. However, when you're doing it through this tiered entity structure, you also have an active trader business requirement that you don't have with a qualified opportunity zone business property structure where you own the asset directly. So the question is, like a prime example here would be, what if all you have is a portfolio, a newly constructed portfolio of properties that are, triple net leases for Walgreens or something like that? Does that really elevate to the level of being a trader business? And so those are some of the things that you have to work through. When you work through this tiered structure, there's certain businesses that you just can't invest in and have it qualify as a qualified opportunity fund. So some examples of that would be golf courses, country clubs, liquor stores, casinos. You do not have that business exclusion requirement on the qualified opportunity zone business property side. So as an example, if you found a piece of land that was located in one of these designated census tracts, you could theoretically do a golf course directly there when the fund owns the asset directly. However, you wouldn't be able to do that through this tiered entity structure. We're not hearing a whole lot of people that are doing golf courses, so it hasn't been much of an issue thus far, but it is something else that's out there. There's also a working capital safe harbor. So in a lot of these projects, it's not as if you take in the investor equity and you start writing checks immediately to go vertical on the project. So through the tiered entity, you have a working capital safe harbor, which basically allows the entity to sit on some excess capital. And as long as that is spent within 31 months, and it's clearly designated for this particular project, you can use a working capital safe harbor of 31 months to basically build out the project. Again, you don't have that same working capital safe harbor on the qualified opportunity zone business property side. And so a lot of people are saying, well, so how long do I have? And that's kind of one of the questions that is out there is we don't really know how long you have. So you either utilize this working capital safe harbor requirement because there's certainty there and we know it's 31 months, or you're kind of in this more unknown area where you're just not sure how long you have to get the project built. On pre-existing owned property, so one of the requirements for the program is the property has to be acquired by purchase after December 31st, 2017. So for those of you that have assets that were acquired 2018 forward, this is less of an issue. For those of you that actually own land, vacant buildings, projects that could require a substantial amount of renovation or deferred maintenance, and you already own those prior to December 31st, 2017, the question is, how do I make a deal work when you have that type of situation? There are ways of making something like that work, but you do have to get more creative on the structuring side. And a lot of these transactions, we just have very limited guidance on whether or not they work. So you're kind of in an area with more uncertainty where you're hoping that, you probably meet the intent of the program, but we don't have anything explicit from Treasury saying, hey, this project works. But an example of something like this would be you could sell the asset, you could syndicate the deal, you could still retain an ownership in the Qualified Opportunity Fund, but because you can't trade properties amongst related parties and qualify as a Qualified Opportunity Fund, you'd be looking at retaining a less than 20% or less interest in the Qualified Opportunity Fund. But this is a very viable structure. So if you had a sponsor who owns some land and they were hoping to build a multifamily project on it, for example, they could theoretically sell the land to the Opportunity Fund, reinvest their proceeds from the land sale into the Opportunity Fund, retain an ownership of 20% or less, and still qualify. And we have seen some transactions like that. Frequently, there's a co-invest requirement of the sponsor anyway, so it's a way of, satisfying the co-investment requirement, syndicating the deal, fundraising for the asset, and moving forward with the project. So this has been a pretty viable alternative. But if somebody had a piece of property that they just really loved and they already owned it before December 31st, 2017, and you really want to retain that as kind of a family legacy asset or as a personal legacy asset, it gets more complicated unless you're doing like a ground-up development deal on land. If it's an already built structure, it's a lot more difficult to structure. You could also think about land contributions into a JV entity. So in other words, rather than selling the land, you would contribute the land into a new co who would move forward with the vertical construction of the project. Something like that could work as well. The issue with that is you likely don't have a good cost for your 70% test and your 90% test because you're not meeting the acquired by purchase requirement. However, if you have land that's been held for a long time and it's got a low basis, and you're using, you could potentially be using that lower basis for purposes of calculating the 70% test and the 90% test, and it's a pretty intense kind of expensive project, you could still qualify on a new development or substantial rehab project. The other thing that we're starting to see take place is ground leases. So frequently cities and counties have done this for affordable housing projects where they continue to own the land and they lease the land to the developer on anywhere from a 30-year to a 99-year land lease. And then the developer builds the improvements on leased land something like that would also be a conceivable structure when you have land that you already own in an opportunity zone. Debt guarantees. So one of the issues that's frequently coming up here is when you bring in your investors and they're investing capital gain and they're getting the qualified opportunity fund, favorable tax advantages, the trade-off is they have zero basis. So it's kind of like a 1031 exchange. You haven't recognized your gain, so when you roll into the qualified opportunity fund, you have zero basis. And if it's a new development or a substantial rehab project, frequently you're going to use debt, and that debt, you're going to build your project, and because there's all this accelerated depreciation that's available under the new tax law, you can end up in a situation where there's really substantial depreciation deductions in the first year in particular, but the sponsor has no basis in their interest. So the question is, can the sponsor use those losses? If it's non-recourse debt, where nobody has actually personally guaranteed the debt and the sole security for the debt is the underlying property, something like that can work because the investors will get their allocable share of the debt, which will give them basis and allow them to use the losses. However, frequently the debt's guaranteed by somebody, and frequently it's the sponsor. And so if you have debt that's actually guaranteed or there's other assets pledged as collateral, that can be problematic for getting the losses to the investors. And so then the question is, okay, how are we going to, first of all, does that matter to us? Because the investors will get them eventually whenever they get their basis step-ups and they recognize the gain at the end of 2026. So it's really a temporary issue. Or if it's important to try to get the losses to the investors up front, the question is, how can we structure around that? They can be co-guarantors on the debt, but obviously that comes with real economic risk. Not very many investors are likely going to want to do that. There can also be contractual arrangements or indemnification agreements between the sponsor and the investor where the investor agrees to make the sponsor whole if any one of these guarantees is ever called upon by the bank or if other assets pledged as collateral are actually taken by the bank. So there are some ways of structuring around that, but just something to pay attention to. Equity partners, capital gain versus fresh capital. We touched on this a little bit already. There's no issue with the Qualified Opportunity Fund taking on fresh capital from either investors that are also investing capital gain or from entirely different investor group altogether. It doesn't violate the status of the fund, and you can still obtain the favorable tax advantages. However, the investors that put in the fresh capital, they don't get either the temporary deferral or the permanent exclusion on the gain. So just keep that in mind is for those investors that are putting in fresh capital, they're really not going to get any of the tax advantages associated with the opportunity fund structure. And then things do get complicated when it's a mixture of both fresh capital and capital gain income from a single investor, just because of mathematically how you work through the formula. If they ever dispose of their interest, you can also do that. But basically, the investor will get some of the tax advantages for the capital gain income, and they will not get it for the fresh capital. So those are just some commonly encountered issues we're seeing on the structuring side for the early people that are getting into the Qualified Opportunity Fund deal flow. So, Emily, I'm going to go ahead and turn it over to you for the next polling question.
All right. Our third polling question: how likely do you think the QOZ program will live up to the hype and spur widespread investment in disadvantaged areas? And your options are not likely, somewhat likely, very likely, or not sure yet. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Give everybody a few more seconds. And let's go ahead and take a look at the results. Back to you.
Okay, thank you for your responses. So looks like a majority of the people think that they will be somewhat likely. So yeah, I think we've heard a lot about the benefits and seen a lot of the positives that this new legislation can offer areas in need. I think we also, it behooves us to think about some of the potential pitfalls here, and I think some of the trends that we're seeing as people are starting to realize while this is a great program and has many benefits, it does have some limitations. So we wanted to run through some of these and as they're sort of coming to fruition. So, I think the first one is timing issues, and Chris, touched on some of these, but if you sort of work through these timing elements, especially when it comes to real estate transactions, it runs into some issues. So, for instance, the 31-month safe harbor that Chris mentioned, where all the capital within a fund has to be distributed into the actual deal. In many areas, California in particular, where I sit, that's actually very hard to do, especially when you're talking about development deals, in many cases ground-up development deals, or significant renovation, which is required by the legislation. That oftentimes is somewhat impossible to get done within 31 months in jurisdictions that have extended entitlement and planning processes in place. So there's a lot of California groups, sponsors that while this legislation seems like a great thing, it's in practical terms, it's hard to take advantage of in some of these California markets and in other markets where there's a long entitlement process. So that's one of the major ones that we're starting to run into. And then when it comes to, as Chris also mentioned, acquisitions need to have occurred later than 2017, notwithstanding some of the ways to get around that. But if you need to invest in either 2018 or 2019 to get the full benefits, we're rapidly approaching the end of 2019. So the full benefits being the full step up in the basis and the full tax advantages. So to get real estate transactions done by the end of 2019, unless the IRS decides to change some of these things, may be challenging. Next is just cost and complexity. I think people are starting to realize that while this all sounds great, it is fairly complex, and you do have to spend a lot of time with your advisors and your lawyers on how to do it properly. In many cases, securities laws comes into play, which many folks have not dealt with before. And there's ongoing compliance. And as I mentioned earlier, if we continue to see some of this political backlash, some of these evolving regulations may step up the compliance element, and that may be burdensome to some as they're moving through the process. The next one is liquidity disconnect. So most often when you have a capital gains tax to pay, usually there's been a transaction and you have cash on hand to pay the tax if you choose to do so. The legislation is set up here where the capital gain is deferred until 2026. You have to pay your capital gain in 2026. Now, that can be reduced, but nonetheless, it still needs to be paid in 2026. And in many cases, to maximize the tax benefits here, you need to hold this investment for 10 years or longer. So creates this disconnect in cash on hand versus when the tax bill is due. So, that may create some issues for people down the line in 2026, and, they may not have the liquidity to pay the ultimate tax bill, the capital gains bill in 2026. So just something to think about and keep in mind. Another thing that people are starting to ask questions about is, a lot of investment activity here in Opportunity Zone is going to happen in 2018 and 2019. It's a 10-year program to maximize the tax benefits. and what happens in 10 years when these things start all unwinding and funds start liquidating and selling properties. Will that create an issue in the marketplace? And then lastly, I mentioned it earlier, are there sufficient number of projects, feasible projects, to support the fundraising in this program? Because if you look through it, the consensus is that the tax benefits here add about 3 to 4% to your internal rate of return on an investment in an opportunity fund. So while that's substantial, it's not necessarily, doesn't take an unfeasible project and make it a feasible project. So, these investments still need to make sense on a standalone basis, and the tax incentives are gravy on it. So if you really look through where these 8,000 plus opportunity zones are throughout the country, there's still a fair amount that no matter what incentives you throw at them, still probably will not attract private capital. They either have, rising poverty rates, declining incomes, or declining population base, which all in all is not a great place to invest private capital. But nonetheless, we do think that there's going to be a sizable amount of feasible projects, but there are questions being answered on whether or not there's enough to support the fundraising. So with that, I'll turn it back over to Chris, or to Emily for our last poll question.
All right, our final polling question. How much equity do you expect to deploy utilizing a QOF investment vehicle? Less than $5 million, between $5 million and $20 million, more than $20 million, or I'm just here to learn more. And once you have completed all CPE requirements today, you'll be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Just a couple more seconds. And let's go ahead and take a look at the results. Chris, back to you.
Great. So yeah, a lot of people I think are still, based upon the poll results here, a lot of people are just trying to learn more about the program. Again, since we are pretty early in terms of the actual deal flow, not surprised to see that. So yeah, that's kind of consistent with our expectation. For a few minutes here, I was just going to, we have received a lot of questions from clients and folks that we work with relating to the Opportunity Fund versus the 1031 exchange, which is a very tax-advantaged way of exiting real estate and re-entering a new piece of real estate and deferring the tax on it. And what's the difference, and are there advantages and disadvantages to both? And there definitely are. So I was just going to highlight some high-level differences on these. With a 1031 exchange, when you exit a property and you buy a new piece of property, whatever the sales price is has to be redeployed into the new property. So you think about your debt, your equity, you have to have at least that much or more debt and equity on the new property. With a qualified opportunity fund, you only have to invest the gain. So if you had a $2 million asset with a $1 million basis and a $1 million gain, if you did a 1031 exchange, you'd have to invest $2 million. If you did a qualified opportunity fund investment, you'd only have to invest $1 million. So if you were trying to return some capital to yourself and not necessarily put all of the proceeds back into the real estate market, the Qualified Opportunity Fund could give you some more flexibility there. In terms of time constraints, with a 1031 exchange, you have 45 days from the date of close of the old property to identify your new property, and you basically have 180 days to close on the new property. With a Qualified Opportunity Fund, similar time constraints. You have 180 days from the date of the sale or exchange to reinvest the proceeds into a Qualified Opportunity Fund. However, if some of your capital gain is actually coming through a flow-through entity. So maybe you sold an operating business, and that's coming through an LLC or an S corporation. Maybe you have some gains from another real estate partnership, a private equity fund, or a venture capital fund. If you have that type of situation, you can actually use the year end of the partnership that's generating the gain. So if you had a December 31st year-end partnership, you could use that as the date on which your clock starts ticking for the 180 days. You can also elect to use the date that the investment partnership sold the asset. So you do have some more flexibility when the gain is coming through a flow-through entity like an S corporation or a partnership. On the investment structure side, with a 1031 exchange, it's fairly rigid. Whatever legal entity or individual sold the old property, they must buy the new property. So for those of you who have done these types of transactions, you frequently encounter tenancy in common type structures for this reason, because certain partners in a partnership, they don't want to all go buy something together, so they roll out into a tenancy in common structure. So the partners can kind of separately go do their own 1031 exchanges. More flexibility with a qualified opportunity fund where you can really invest even as far up as the individual level when you've got gain coming through kind of a multi-entity partnership structure. So you're not going to end up with a lot of these tenancy in common type structures that you would have with a 1031 exchange. On the gain deferrals with the 1031 exchange, it's indefinite. If you take your gain and you roll it over into new property, it sits there until you sell the asset. With a qualified opportunity fund, it's deferred until the earlier of the date of sale of the asset, or December 31st, 2026 is kind of the day that you pony up if you still own the asset, which means the tax is generally due in April of 2027. With a 1031 exchange, you don't have a gain reduction, but you do get a full basis step up upon death for whoever inherits the property. Qualified opportunity fund, as long as you hold it for 5 and 7 years, you get 10% and 5% gain reductions. So you do have some reductions in your gain that you don't have with the 1031 exchange. And then capital gains on sale. Again, with the 1031 exchange, if you're going to ultimately exit the property in the near future, you've really just bought yourself some time because you can defer the tax until you sell the next property. With a qualified opportunity fund, you actually get the permanent exclusion on the appreciation in the qualified opportunity fund investments. That's a permanent difference between a 1031 exchange and an opportunity fund. On exit with a 1031 exchange, you sell the property. As the law is currently written, on exit with a qualified opportunity fund, you actually have to sell your interest in the fund. So you're either selling a partnership interest, or if you have like a REIT or something like that that owns the real estate, you can actually liquidate the asset within the REIT and then take the proceeds and distribute the cash to the shareholders in liquidation of their interest. But you're generally selling your interest in the entity as opposed to the underlying property. And then you've got the state conformity issues, and this is a big one, particularly with high tax states like California, where they can take as much as 13.3% of your gain. Pretty much every state, with the exception of 1 or 2, conforms to 1031 exchanges, which means you can exit the property, you can roll into new property, and you can defer your gain for state tax purposes. It really depends upon the state with qualified opportunity funds. I would say that generally, now that the program has been around for a while, there is some activity here. States, and in particularly cities and counties and local governments, they are seeing this is a way of generating interest in projects that they want done in their communities. So our expectation is you'll start to see more state conformity. Even in California, Newsom has it in his budget for 2019. We'll see where that goes. But whether or not you get the tax benefits really depends upon the state where the project's located and the state where the investor lives. So you have to be mindful of that when you're structuring your qualified opportunity funds for the tax deferral, because you could end up having to go out of pocket on the state side to cover your state tax obligation. So on a high level, that was kind of what I wanted to cover on the comparison of the opportunity funds to the 1031 exchanges. We are hoping to get some more guidance on regulations that should be coming out in the next 2 to 4 weeks. Clarification on refinancings and can you do that? Carried interest, triple net leases, do those qualify? Measuring the 50% of gross income when you're trying to meet the definition for an operating business as opposed to a real estate project. So I would say thus far the regulations have been very taxpayer favorable. Obviously, we're hoping that trend continues with the new set we expect to see in the next 2 to 4 weeks here. So with that, Emily, I think I'll turn it over to you so we can do a little Q&A here.
All right, thank you. And if you have a question for either of our presenters, you can type that into the Q&A submission box right beneath the slide view. And let's see, we do have quite a few questions today. Our first one, if you don't have any capital gains within the last 180 days, would there be any point in doing a QOZ project? Is this whole concept purely a vehicle for deferring or reducing capital gains?
So great question. And Chris Herthel, please feel free to pop in anytime. But yes, this really is kind of it's a tax-motivated and a tax-efficient structure for redeploying capital gains into these projects that are located in certain communities where they want economic development. So that really, I always explain it, there's 2 benefits. There's the temporary exclusion where whatever you invest into the fund, you're able to reduce that gain by as much as 15%, and you're able to defer the payment of tax on that until December 31st, 2026. That's one benefit. The second, and the much more sizable and interesting benefit, is there's a permanent exclusion on any appreciation in the qualified opportunity fund investment. So when you take your old gain and you put it into the fund, whatever you turn that into, there's a permanent exclusion on the appreciation. So that's kind of where the, investors are really excited about that permanent exclusion. That's the attractive part of this from just kind of a, tax advantageous, that's where the real tax advantage is here. It's the permanent exclusion on the new asset.
All right, thank you. Our next question. Can you move the same entity property sale proceeds into a related party-owned property?
Okay, so that's a good question, and it on this one it really does depend. But basically, what you could do is you could sell a piece of property. You could take that capital gain income, and then you could go reinvest it into a new project, and that could be a new project with a related party. Where it gets challenging is when you're basically trying to sell the project to yourself, and if you're trying to structure something like that, you can't have an ownership. Your ownership has to be 20% or less in the qualified opportunity fund if you're investing in a new property. So that's kind of the magic threshold there.
All right, our next question. I don't have an asset to sell and defer opportunity zone gain, but I have capital I want to invest in opportunity zone property. Can I get the benefit of the 10-year holding period without having an asset sale and the related deferred gain?
It basically, to get all of the advantages, the tax advantages associated with the qualified opportunity fund structure, you have to invest capital gain income. So really what that means is prior to investing in the qualified opportunity fund, within 180 days prior to that date, you have to have some sort of capital gain event. in order to get all the tax advantages associated with the new project. There's no like direct tracing rule or anything like that where you have to go take the cash that you got from the sale and then go put that cash into the new investment. However, within that 180-day period preceding the investment in the fund, you have to have a capital gain event of some kind in order to get all of the tax advantages.
All right, our next question. Any sense for how refinance proceeds will be handled?
So that's a great question, and I would say that's one of the more popular questions that are out there. Frequently, it happens with real estate. You put together a deal, the underlying asset appreciates in value. You can refinance the asset. You can distribute the refinance proceeds to the original investors. You defer the gain for everybody because you haven't actually sold. There's no sale or exchange of the underlying asset. All you're really doing is leveraging the equity in the asset. As the law is currently written, you can do that with qualified opportunity funds as long as you don't end up in a situation where you have a distribution in excess of basis for the investors, because that would trigger a sale or exchange, and it would negate all of the tax benefits associated with the opportunity fund investment. So as the law is currently written, you can do that as long as you don't run into a position where you've got a deemed sale or exchange for the investor. This is one of the items where we're really hoping Treasury addresses this specific question and follow-up regulations, because it's very common. And you've also got the tax due, the tax coming due at the end of 2026. So the question is, well, hey, can we go park our cash in this qualified opportunity fund? Hopefully over 7 years there's some appreciation there. We can refinance it. We can pull out some cash. We can use that to pay our tax from the original investment. So we suspect that will be taxpayer favorable, but that's one of the questions that's out there.
Thank you. We have time for a couple more. Aren't the losses limited under the passive activity rules for investors not actively involved?
Yes, so you do still have those same passive, the passive loss rules will still apply, whether it's a qualified opportunity fund investment or not. So yes, you still have that issue where if they're a passive investor and they don't have any other passive income, they likely would not be able to utilize those losses anyway. That could be limited if they don't have any share of the debt. So that could clearly apply in a lot of situations where really the investor couldn't use the losses anyway, so it's less of an issue. What we frequently see is our clients work with kind of a similar investor base, so they may have gains from one entity, and even though they're passive in that entity, they've got passive income because there happened to be an exit for a particular property that year, and then they can theoretically use the passive losses from the other entity to offset that gain from the sale of the property.
All right, I think we can squeeze in at least one more. On a single asset entity, how do investors sell their interests and exit the fund? Do you need to sell the entity owning the asset rather than selling the asset?
Yes. So let's assume that you have a partnership, a limited partnership, a general partnership, or an LLC. Currently, when you exit the investment, you have to exit the entity itself. Basically, you would have to sell the entity. You would have to, or the investors would have to sell their ownership interest in the entity, something like that. For those of you on the call that know how real estate transactions typically work, usually that's not the case. Sometimes you will see that if there's assumable debt, like HUD debt or something on a particular property, you'll see acquisition of the ownership interest in the entity as opposed to acquisition of the underlying real estate. This is another topic we think they'll clarify in the upcoming regs to give you a little bit more flexibility on how you exit, because in practice, that's just not really what happens. As the law is currently written, that's how it needs to happen, is you have to sell the entity as opposed to the real estate.
All right, I think that is just about all we have time for. If you still have a question, you can, I'll leave the console open if you would like to submit that into the Q&A window, or you can reach out directly to Chris or Chris. We did have some questions that we didn't have time for today, and we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. As I mentioned, I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within the next 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.